Austin, very good to see you. An important topic today: 3 RMD strategies to reduce your tax burden in retirement. Let's start at the tippy top. What are RMDs and how are they calculated?
Yeah, these little three letters come up again and again, right? And
Yeah.
RMD stands for required minimum distribution. And this is something that the IRS forces us to pull out at age 73 now. It used to be 70 and a half, and it can be as old as 75 for some folks. But these are distributions, again, forced by the IRS at those respective ages. And typically, these will begin again at age 73, and they are only from tax deferred accounts. So think
Mm.
things like IRAs and potentially 401ks. And your first year or year one required minimum distribution is approximately 3.65% of your tax deferred account balance. So let's just say you had $1 million in an IRA. That is the only tax deferred money that you had. Approximately in year one, your required minimum distribution will be 36,500.
Okay. And I know that you work really hard to make sure your clients take those distributions when they need to, because if they miss it, there's a significant penalty.
Yeah, of course, the IRS doesn't let us get away with just missing taking these required minimum distributions. So I will add, before Secure Act 2.0, this penalty was much higher, was 50%. Now it is
Whoa.
currently 25%, which, don't get me wrong, is still quite a hefty
Yeah.
penalty, and one we certainly don't want to subject ourselves to. But if we do have that penalty and we get it corrected within 2 years, that penalty actually drops to 10%. But again, with just a little bit of proactive planning, really, this should never be any trouble whatsoever in any
Right.
planning scenario.
Right. Okay, so now let's talk through those strategies. And the first would be to take those distributions as early as possible, which is 59 and a half.
Yeah, this one's a little bit counterintuitive, I think, for some folks because we've been taught, right, defer, defer, defer.
Yeah.
But at 59 and a half, we have access to these tax deferred funds like an IRA, right, penalty free. So at that point, you can intentionally begin depleting or taking assets out of the IRA in a known tax rate environment. That is the key point, right? We are operating in a known tax rate environment today, and I may add a historically low tax rate environment today. So by intentionally kind of taking those assets first, we're letting our other, whether it be brokerage taxable assets or tax-free Roth IRA assets, continue to compound and intentionally bleeding down those tax-deferred
hmm
assets.
And you just said the magic word, our second strategy: Roth conversions. How does this help with RMDs?
Yeah, Roth conversions are awesome and kind of a Swiss Army knife here. So
Yeah.
and essentially, what a Roth conversion is we're taking tax deferred money and intentionally paying the tax in the year in which we make the conversion to a Roth IRA. So let's kind of break it down. We go from an IRA to a Roth IRA. We intentionally increase our tax liability in the year in which we convert. However, not only is that money never taxed again, Roth IRAs are not subject to required minimum distribution. So if you
Mm,
need the money in the future, it's there, it's available, you can access it, but you're not going to be forced to distribute from that account in the future.
I see. I see. All right. And our third strategy is known as a qualified charitable distribution. How does this work?
I love this one for folks who
Yeah.
are charitably kind of inclined here. And essentially, we go from an IRA directly to a 501c3, or otherwise known as a charitable organization. So the money, again, has to skip you, like we see in the graphic here, go directly from the IRA to the charity. And those funds can help satisfy all or a part of your required minimum distribution for the year. However, the kicker is they are not included in your taxable income. So by kind of killing two birds with one stone, right, we get to not only check off the box of our charitable giving, but also help ourselves by not giving any extra to Uncle Sam.
Yeah, no, that I like that one. That's a win-win for everyone. And then just to kind of wrap this up with a bow, Austin, this all comes back to strategic tax planning, being proactive about it. A lot of us assume we're going to be in a lower tax bracket when we retire, but that's just not often the case.
Yeah, that's a really big misconception, I would say.
Yeah.
Many folks, given whether it be part-time work, pensions, or even just regular distributions, right, from IRAs or perhaps those RMDs, right, we find ourselves in a higher tax bracket. So we need to make sure, first and foremost, that we have a comprehensive retirement plan that includes tax planning as a facet of that plan to really nail down, what does our tax picture look like? What does our retirement plan look like? When are withdrawals scheduled to begin, right? All of these different aspects need to be coordinated together, and that comes down to having a retirement plan in place.
Being proactive is what it all comes back to. So, Austin, if somebody wants to talk through any of these strategies with you, how can they get a hold of you?
Yeah, you can give us a call at 919-322-4113 or send us an email at info@patriotwealthnc.com.
Great. Austin, thank you.
Thanks, Aaron.